We are told this is a new gold rush, a time of artificial intelligence. We hear promises of great change. Leaders stand on big stages. They show flashy demos. New powerful models with big names. GPT, Gemini, Grok. Some whisper AGI is near. Jensen Huang, Sam Altman, Elon Musk. They paint a world transformed, but it is very expensive. The engine is the data center, power, cooling, networks, at massive scale. And now, the story is changing. The AI gold rush promised endless growth. A new digital frontier, built on silicon and steel. But now, cracks in the boom are showing on construction sites. The initial frenzy is meeting a harsh reality. All across the country, dozens of mega projects have been paused, scaled back, or canceled entirely. You won't see this on the front page. The news often lands quietly, buried deep in regulatory filings or obscure local reports. A footnote in a quarterly earnings call, a withdrawn permit application. But some deals are too big to hide. One headline case, Oracle and OpenAI, a giant multi-year deal to build and lease dedicated data center capacity to power OpenAI's future models. The scale is staggering. Estimates reach into the hundreds of billions of dollars over just 5 years. To put that in perspective, in the final year alone, the spend could top the entire annual revenue of a major cloud giant. This is the core of the dilemma. OpenAI is famous, a household name, but it is not yet consistently profitable. If the main tenant's business model falters, or if a new, more efficient AI model makes the old hardware obsolete, the lenders are left with empty halls and catastrophic losses. The equation seems simple. AI needs massive compute. Builders need guaranteed rent to secure financing. But the math must work for everyone. For a long time, the industry ran on faith, on the belief that demand would always outstrip supply. But hope is not a strategy. And now, the banks are catching on. The financiers are asking harder questions. They're scrutinizing the creditworthiness of tenants who have never turned a profit. They're looking at the astronomical upfront costs for power, land, and specialized hardware, and comparing it to the uncertain revenue of the AI company leasing it. For many of these speculative projects, the math just does not work. When the math doesn't add up, a project becomes a money pit. The scale of these builds is staggering. To fund them, developers take on massive debt, often billions of dollars. This initial capital is just the entry fee. The financial models are incredibly fragile. Even small interest rate hikes can completely erase already thin margins. A project that seemed possible on paper suddenly looks impossible in reality. Many loans are structured as interest only during the construction phase. This keeps initial payments deceptively low. But once the facility is built, the bill spikes. Suddenly, both principal and interest are due. Any construction delay, supply chain hiccup, or gap in finding a major tenant can sink the entire project before it even goes live. Then there's the hardware. The specialized AI chips are insanely pricey, and these centers don't need a few. They need hundreds of thousands to be competitive. But the spending doesn't stop there. Power and cooling systems add huge ongoing operational costs that can rival the hardware itself. When you factor in all these expenses, some deployments actually show negative gross margins. The fundamental question becomes unavoidable. How do you build a sustainable business if each customer use actually loses you money? Sophisticated investors see this precarious math. They model the risks, and many decide to pull out. We're already seeing the fallout. Blue Owl recently exited a multi-billion-dollar deal with Oracle, and S&P has flagged the sector's growing credit risk. The smart money is getting nervous. Beyond spreadsheets is a harder limit: electricity. It's a physical reality, governed by physics and concrete. A limit that can't be optimized away with software or clever accounting. A single AI campus can draw a city's worth of power. We're talking hundreds of megawatts, sometimes even a gigawatt. Enough to power a medium-sized city with hundreds of thousands of homes. All for one facility. Our grids were not built for this sudden, concentrated demand. They were designed for steady, predictable growth over decades, not an exponential explosion in one spot. Getting that power requires years of planning and massive upgrades. It's a complex, multi-stage process involving environmental reviews, engineering studies, and regulatory approvals. You need new power plants, new transmission lines, new substations. Each piece is a monumental undertaking. Securing a grid connection can take 5 to 8 years, sometimes longer. The queue is already backed up, but the loans that finance these projects run on a much shorter timeline, typically 4 to 6 years. The math doesn't work. If power lags, revenue can't start. The interest payments pile up while billion-dollar assets sit idle, and communities often push back. They see the strain on their resources, but the promised jobs are few and highly specialized. In places like Michigan and Texas, this leads to delays and lawsuits, grinding projects to a halt. Rushing this process is dangerous. Power done wrong can explode or burn. The stakes are incredibly high. Suddenly, optimistic timelines become fantasy. The project plan collides with the hard wall of reality. For many ambitious projects right now, the power just isn't there. It's not a question of money, but of physics and time. And for every day of delay, the clock keeps ticking on the investment. At the core is the GPU, mostly from Nvidia. Racks can cost millions. A site needs thousands. New generations arrive yearly. Blackwell leaps past Hopper. In 2 or 3 years, today's chips feel old. Value drops fast, like a fleet of luxury cars losing value day one. New chips need new power and cooling, often new plumbing. Form factors change, upgrades become rebuilds, profit gets crushed. We hear about giant checks, SoftBank, 30 billion, rumors, Amazon, 50 billion, maybe, Nvidia, more billions. But many deals never truly close. Circular financing, money goes out and comes right back. Invest, customer deal, spend at the investor's cloud. Looks like growth. Often it's just looped money. It hides weak real demand. VCs step back. Only giants remain. We hear GPT, Gemini, Grok, AGI, and ads to fund it all. When you fund a buyer to buy from you, that's not a healthy market. Investors should look twice. If half these mega sites never happen, the pain is real. Not just for billionaires. Communities feel it. Banks eat big losses. Contracts break. Jobs vanish. Tax breaks traded for growth that never comes. Left with dust and disappointment. In some towns, even scars remain. This is proof you can touch. A shell in Texas. A shell in Michigan. That site can crack market confidence fast. The bubble becomes visible, like the empty houses from The Big Short. People will say, "This isn't real," and the damage spreads. This isn't the end of AI, it's the end of the beginning. The blank check era is over. Now comes a sober phase. Survivors will show real business models, real problems, real value, revenue that lasts, not burn. Stop watching hype. Watch numbers. Check balance sheets. Check profit and loss. Did the deal actually close? Did the site get power and go live? The truth is in filings and construction reports. The winners will be useful, not flashy. The gold rush slows. A steadier chapter begins.